Is working till 65 really worth it if you have a pension and $1 million or more saved? That's what we're going to break down in today's episode of Joe Knows Retirement. And this one should be a fun one, but also a very encouraging one for those that maybe think they have to continue working for maybe healthcare insurance, or maybe they're worried about running out of money. But what we typically see with this crowd, this is the crowd we specialize in this channel specifically for those people, is that those people have more of a chance to retire earlier and also less concern throughout their retirement typically, because they're in what I call the 2% club. And this is actually a book that I wrote that's coming out here soon on the concept that those who have a pension, there's only 20% of you out there. And for those who have $1 million or more saved, that's only 10% of the entire country. And so if you combine those two percentages, you're only left with 2% of the population in this category. And so it's a unique situation. Taxes are probably going to be your biggest concern. That's probably going to be the thing that we want to see people plan for the most in that category. But retiring early, as we're going to show you today, may not need to be one of those concerns that you have. It could be something to jumpstart that retirement that you've worked so hard for, right? We also talk to those who are Midwestern millionaires. They've probably worked for 30 or 40 plus years to get to this point. And now they've reached financial freedom. And so we're going to break that down here today and talk about how you may be able to have more purpose with your money, maybe be able to spend more. I know that's hard for Midwestern millionaires considering they're the best savers, but the worst spenders, as we always call it. Or maybe we look to gift to our loved ones or give to charity. So that's what's in today's episode, and stay tuned for some fun.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
My name's Joe Schmitz. I'm the CEO and founder of Peak Retirement Planning. And if what I just talked about, if that's glaring to you and that's your situation, go ahead and subscribe to our channel. If you subscribe, that will keep updated videos coming to you throughout the week, and that will allow you to get more educated on this information as we go. And it also helps us reach more people, especially those in that 2% category. We hear so often that we're looking for this type of planning, or our advisor doesn't do this type of planning, and they're glad they found our educational resources. So we're here to add some value. This is what we do every single day. And if we can encourage you to be in a better situation, that's what this channel is all about. So obviously we broke down that having a pension allows you to have more freedom in your retirement. So let's break down the numbers here a little bit more. And what my hope of this is to really give you more confidence and encouragement to know, you can take a deep breath. You could probably retire now, or even yesterday in most cases when we sit down with clients in this situation, so that you can live that worry-free and comfortable retirement. And I do want to make it very clear, this is all generic information. I don't know your specific situation. Everyone's situation is different. Although with this channel, it allows us to really target into that 2% crowd that most people who watch this are in very similar type situations. So even though we would never do a cookie cutter plan for someone and two people in that 2% club, everyone has unique situations. But I just want to make that clear that you're going to really want to run your numbers for your situation. But let's talk about what that could look like for you as you start to brainstorm. And so let's say that you are 60 years old here today, and you're watching this channel and you said, hey, I got 5 more years that I'm going to work. And maybe one of the biggest concerns you have is health insurance. And that's something that we see as a real concern for those who retire before 65. And the reason why is because health insurance costs have gone up rapidly, but also until you reach Medicare at 65, then you'll be on Part A, which you've paid for all your life. And then you'll have the opportunity to add on Part B and D, which the majority of people out there do. And so with Part B and D, you have to pay an additional premium for that Medicare coverage. And that could obviously depend on your income. So the higher your income the more you're going to have to pay for Medicare. You don't get better coverage, but this is something that we help a lot of our clients plan for, because if they have a pension, if you have $1 million plus saved, health insurance, even not only early in your retirement, but ongoing through your retirement, could be a big, big issue. So we're going to kind of break that down of how it could actually save you money by retiring at 60 on health insurance over your lifetime, even though you may have a little gap there between 60 and 65 that you're going to have to come up with, because your employer is not likely going to cover you for health insurance anymore. Now, some employers will cover you up until 65 at a lower cost, and that could be something that could be very attractive, even more of a reason for you to retire early. And so what we look at here is, think about it. If you're 60 years old, Medicare premiums for Part B start to get calculated at age 63. And the reason why is because it looks back 2 years. So when you turn 65, it goes off your 63 income. When you turn 66, it goes off your 64 income. And so if there's ways that we can start to increase our income now so that when we are at 63 and on, that we're going to be able to show a lower income to the government, then that could be something that could save us a lot of money long term. And so for a lot of our clients, we may look at something like a Roth conversion. And this is a very important strategy that we would see people that are looking to retire early to obviously add some more alpha, is what we call it, which adds more value to your retirement plan to make it more tax advantageous. And so a Roth conversion is when you move money from a tax deferred investment over to a tax-free investment. Now, when you do that, you have to pay taxes here today. So let's say you are going to plan on retiring early. Well, what is likely going to happen to your income? It should go down a bit. And especially if you're not on Social Security yet, and maybe all you have is that pension that you've had, or maybe you decided to take a lump sum and you don't have a monthly guaranteed amount coming to you ongoing. And so if that's the case, that creates a lot of opportunity to take advantage of the lower tax brackets that we're seeing right now. The one big beautiful bill, just lower tax rates moving forward. And especially for those in this crowd, you're gonna have more of an opportunity to take advantage of those lower rates. And then if tax rates ever go up in the future, you're gonna be able to capitalize on taking out from a Roth account where it's tax-free, or in the future, so you don't bump up those Medicare tiers where you could pay double or triple more for Part B premiums in retirement. And so that could be a really good strategy for you to consider if you are going to retire early. But I'll even tell you, even if you are still working and still not ready to retire yet, then we still do Roth conversions for many of our clients in this scenario, because you've probably always been told, I'll be in a lower tax bracket in retirement. And that's simply just not typically the case for the crowd that we work with. You know, for most people out there, I would agree that that is a realistic statement because of what's called the standard deduction. So the standard deduction says that if you have up to about $30,000 of income in retirement, you don't have to pay any taxes. That first amount is tax-free, and then you go into the 10 and the 12 and the 22, 24% tax brackets. And so most Americans, they don't take out more than that. In most of the cases, they're able to keep their Social Security even tax-free as well. You obviously saw with the one big beautiful bill, the $6,000 increased deduction per spouse if you are 65 or older that got put in place. The whole idea of that was to keep Social Security tax-free for more people. And so that they showed that about 80 to 90% of people will have Social Security tax-free. The problem is that's not likely going to be the 2% club. The 2% club is going to be that 10 to 20% whose Social Security is taxable, or even up to 85% counted as income, is what we typically see due to what's called the Social Security tax torpedo, which can cause you to pay a lot more in taxes if you increase your income beyond that point in retirement. I've done some other videos on this channel as well if you're looking to learn more about how Social Security is taxed, because obviously that's going to be a big part of when you decide to take Social Security. But also, if you retire early, are we going to turn Social Security on at 62? Or are we going to wait till 70 or do something in between? So there's a lot that you have to consider, not only your health, but also you have to look at the taxation, and also you have to look at it, if you take Social Security early, you may not be able to Roth convert as much money on the topic we just talked about because your income is going to be higher during those points. So all things to consider. And back to the health insurance, idea as well, is from 60 to 65 in that example, you're going to have to get health insurance on your own. And obviously the Affordable Care Act is an opportunity that a lot of people were using in years past. Now that is becoming less advantageous now, because if your income is lower, you still likely are going to have to pay more at this point. So a lot of people would use the Affordable Care Act and get very low health insurance costs before 65. They would just keep their income lower. Now obviously that may not be the case for those with pensions. They may already have in the past, broken out of that threshold there. But now we're looking at more, maybe it's not the Affordable Care Act, maybe it's a private policy, or maybe it's COBRA, or maybe it's something to bridge the gap until you are 65 for Medicare. And then the other consideration to think about is when you are 65, Part A and B and D, we already talked about that. Part D is prescription drug plan, but also you need to look at, are you going to do the Advantage or supplemental Medicare plan? And I highly suggest you work with an expert when that time comes. Also, if you are 60 years old right now, Medicare plans can change a lot before that time, so I wouldn't encourage you to look into those plans too much. We typically recommend our clients 6 months before they turn 65 to really start making sure they're taking a close look at that. And that's something we do for all of our clients. We help them find the right Medicare plans when that time comes, so they don't have to worry about it. And if you work with a team or maybe you're DIY in your retirement, we would highly encourage you to at least work with someone who's a Medicare specialist, something that they do that every day. You'll still pay the same premium whether you go with them or whether you go to Medicare.gov and get a policy online. It's all built into it and it's same. So find someone you trust, find someone who knows the plans, who can educate you, and then you can work together with them to find the right plan. Obviously, steer away from people that are going to try to push you to do one plan versus the other, and really try to encourage you, because the different plans are good for different people. And so just about understanding your needs, your health needs, your health issues, and what that could look like for you as time goes. So let's talk more about how you're going to get this income if you may have a gap, if you haven't started Social Security, maybe your pension's delayed, or maybe you just want to enjoy more of your retirement early on. I mean, you didn't retire early for no reason. You retired early so you could maybe travel more, spend more time with your kids and grandkids, and do the things that you may not be able to do in the future. We hear a lot of our clients say that during what we call the go-go years, early on in their retirement is when it's going to be most enjoyable. And one thing our clients have always told me that I've took personally is, hey, make sure you travel now so that you can enjoy it more than later on. And so that's something I personally do. I take 3 international trips at least every year so that I can see the world when I've got the most time to do it, when I've got the most health to do it. And obviously, to see all the different cultures really opens your perspective and your mindset to what's out there. So we'd always encourage clients to do that as soon as they can. And so what a lot of people will do is they'll bridge the income need that they need, maybe until Social Security starts, from their investments. And so a key thing to think about here is, if this is you, is to make sure that you're pulling out of your investments strategically. So 2 things to consider here. 1, you want to make sure that you're not taking from an investment that may be at a loss. That can be what's called sequence of returns risk, and that's when you take out money when the market's down. And so think about it this way. The market's down, that's 1 loss, and then you take out money, that's 2 losses. And the question becomes is, how long is it going to take for that portfolio to rebound? And so if you have $1 million, and let's say that a market downturn happens and now it's worth $600,000, something like a 2008 or something more disruptive in the situation. If you had everything at risk, everything in equities, well, if it's $600,000 and now you want to take out $50,000, well, now you only have $550,000. And now instead of taking out about a 5% withdrawal rate, it's a higher withdrawal rate at that point, which is going to cause your portfolio to not likely rebound and likely to run out sooner. So again, not a lot of our clients in this crowd are worried about running out, but they do want to be wise and smart about how they are utilizing their investments so that it can last as long as possible, but also probably more importantly, so that they can take more out from their investments as time goes. And so we're typically encouraging those to make sure that if you have income needs within 3 to 10 years, depending on your conservativeness and how aggressive you want to be, make sure that money's protected. Right now you can get some pretty decent interest rates right now that could be very attractive and could be a reasonable rate of return for someone. You may not get as much return as something in the market, obviously, but you don't have to deal with the ups and downs, and then you can know that you can count on that money. And a lot of people think of it as, hey, take chips off the table. You've got enough money at this point. You've done the right things. Let's not take any unwanted risk or unneeded risk at this point. We don't need to keep hitting home runs. We just need to keep hitting singles and doubles. We're winning the game, and let's make sure we just get to the finish line the right way. And another way people may fill that income gap is maybe working part-time. And you may think, Joe, that's crazy. I'm not working part-time. And if that's the case, you don't have to probably at this point. But it's more so what we encourage clients to maybe work part-time, or maybe why they tell us they want to work part-time, is to have more purpose, to have more of something they can do. And typically what we see, they've worked at the same employer for 30, 40 years. They may know it's time to move on or do something different, but they've now got a lot of wisdom and a lot of skill sets that they've built up over all the years. And so now could be a chance for them to utilize that. Maybe it's mentoring others, or maybe it's doing something they really enjoy, the type of work they really enjoy, or maybe it's starting a business, whatever it may be. You could look to potentially get income from that as well. And a lot of clients even, they may work at a golf course so they can get some extra perks such as free golf, or, be able to socialize with people with liked interests as them. Or, some people may look to work full-time or even part-time if they offer health insurance, so they don't have to worry about that first concern we talked about earlier. And now they can spend more money during that time because they're not going to have to pay potentially $1,000 or $2,000 on health insurance premiums before 65 hits. And so, we don't tell people that they have to go back to work if we run all the numbers and it works. And we also tell people, hey, if the cost of health insurance are going to be that much, don't worry about it if you can plan and make it work within your plan. That may mean that you leave a little less behind, or it may mean that, less of an inheritance is there. But what's this money there for? Is it for you to spend, give to your loved ones, or to give to charities? And a lot of our clients like to do all three, but you really have to decide what's most important. Do you want to leave your children behind an extra $25,000, or would you rather be able to retire a year or two earlier? And so those are the things that really have to put in perspective for you to think about what is needed there. And again, if you have a pension $1 million plus, there's a chance that your beneficiaries are going to receive $1 million or more. And so you have to ask, when is it too much for them to receive? And so maybe you consider gifting now, or if that's the case, if you're not looking to spend more money now, or maybe you look to give more to charities. But you really have to ask yourself that question. And that's something that we purposely like to plan for with our clients, is to really sit down and map out, what does this look like? What is a children's financial plan in itself, so that when they do pass away, their children are going to be able to use that effectively and use it to expand on their plan and know that is going to be value behind what the money is used for. And that's why we always encourage our clients to make sure that their children are working with us as well. And if you are working within a team already, we would hope that your children are also working with them to ensure that everything is aligned and really more of that family office, so that everything is good, put in place, so that when both spouses pass, or one spouse, whoever it may be, everything can continue to roll as is, and there's no big changes within the plan. And now I talked about earlier the market considerations of taking out of your investment, but the second piece that I wanted to touch on there is to make sure you're being wise about the tax consequence when you take out money from your investment. So very similar to the Roth conversion conversation earlier, but when you go to take out an extra $50,000, you have to understand what's the tax consequence. And there's 3 ways your investments could be taxed. One is taxable. If you take out from there, you may have to pay capital gains on any gain that you've had in that account there. If it's short term, it may be at ordinary income. The other is tax deferred, so that would be taxed at your ordinary income rates. And then the third is tax free, such as the Roth we talked about, where that would be tax free. So it's really important to see, one is how much do you need in each of those accounts to do tax efficient income planning throughout retirement, but also when that time comes, we not only have to see which investment are we selling off, to see if it's up or down, but also the tax impact that we're going to have when we sell off those investments. So you want to make sure that you're really diligent when you take out money from your investments. This is one of the concerns we see a lot of people who retire are concerned about, is how do I take all this bag of money that I saved all these years and turn it into income in the most efficient way, but also to make sure that it's going to continue to grow at the highest pace we can moving forward, and not run out, obviously. So those are some of the planning strategies that you need to concern. But the biggest point that we really have to think about here is, as we talked about earlier, is what do you want to do? What's going to bring you the most joy, but also fulfillment? A lot of people get fulfillment from continuing to work. And if that's the case and you love where you work, you maybe want to reconsider retiring earlier. It may not be, the grass may not be greener on the other side. Or if you're the one who's stressed out and you're just thinking, hey, I'd like to be done. Maybe the employers change their culture, or maybe they're expecting you to do things that you didn't have to do before that maybe you don't agree with. In those cases, it could make a lot of sense to just say, hey, here's my 2 weeks, I'm ready to go. So really think about what that would look like for you. And don't be afraid if the numbers show what you need to see to be successful, then maybe you look to do that, because money is a tool. It's there to ensure that your purposes are best filled, right? And so we need to be the best stewards of this money by wise strategies and wise planning to make sure we can do that. So if this video was helpful for you, go ahead and like the video here below. Also, if you could leave in the comments, what do you think? Are you thinking about retiring early? Are you thinking about working longer? What is your story? We'd love to hear from it. We try to answer all of the comments that people leave to us. This has been a growing channel. We keep growing subscribers, viewers, and we obviously love the platform and love the opportunity to educate people on such an important topic here. And so my name's Joe Schmitz with Joe Knows Retirement here, and we will see you on the next episode.